Not right now, no. I can't do that. No, because we have FOMC. You want me to help you do what? No, we have FOMC. Yeah, FOMC right now. Yeah, I can't do that right now. Yeah, I got to do FOMC. You what? No, don't talk. Don't do this right now. Not right now. We can't do this right now. I'm live. I think the mic's on. Is the mic on? Oh my God, the mic's on. This is just... I got FOMC. I told you I have FOMC. I can't do this right now. Shout out to everybody here on the live. Are you ready for FOMC? Looks like we're already taking a bit of a dump on the nothing burger of 4.5%. But what is he going to say? How bearish is Jerome Powell going to be? And that's really what you want to key in on. All right? That's what you're looking for. I know. We can do it, though. Shout out to everybody here on the live. Thank you for jumping on in. Appreciate each and every one of you for being amazing and being awesome and kicking it with the lifer. May God bless each and every one of you. We're going to take a look here at the chat and see everybody's in here. Do you have a stream like this for stocks? It's all the same, man. The things I teach you, you can just put on any asset in the world and you'll be ready to go. Just keep coming back for more and apply what I teach you to the charts on any asset and you'll be good. You'll be good to go. You'll be good to go. Anyway, let's take a look here. We're going to get the Federal Reserve up and running. We're going to get ready here to listen to Jerome Powell. And he's coming here at 2:30 Eastern Standard Time at about 10 minutos. And I have it up and running. We got Bookmap. Bookmap suggests that we are going to go lower. And let's take a look here. So Bookmap says we're going to dump all the way to 90K, honestly. I mean, that's where the stops are. So a bunch of longs put stop losses here, and that's where we're likely going to go. We'll take a beat down all the way back down. Welcome back. If you're just in the show, get that lemon water out. Hope you're having a wonderful time. I had a nice lunch looking over the water. It was pretty good. I guess it was all right. I mean, the food was all right. I'm not going to say where I went because I don't want to be rude, but if you have nothing else to say, don't say it at all. So my mother, shout out to Decrypted.tax. Keeps the lights on here. One of our favorite and only sponsors, Decrypted.tax. Best place to do your taxes and get it done. Schedule a free consultation today at Decrypted.tax. All right. Don't wait till the last minute. All right. Moving forward, let's take a look here at BTC. So Bitcoin, we told you it would be sideways most of the day. And they brought it up. Then they brought it down. And to me, it looks like they broke the channel. Like we're kind of at the bottom of. Let's take a look at the 15-minute. Now let's get rid of our moving averages. Make this nice and clean for the newcomer here that's just watching my stream for the first time. All right, we'll get rid of. Don't need all these lines over here. So we had this idea that this flag would break to the upside, and it did. That's exactly what we thought was going to happen. And we got the break all the way to 102.9, 103,000, only to get rejected and come right back down, make a bit of an M pattern. You see this? And look, resistance. You can't, and there was a resistance right above there, but you couldn't seem to get back above 103,000, 102.9, and bang. Now there's some wickage back to the upside. Are we going to fight it back on up? Is he going to say something that's going to spark a bullish move? Or are we cooked like a cucumber here? I mean, I've never cooked a cucumber, but are we cooked like a sausage? Are we cooked like burnt sausage? Is everything okay? Am I live? Did you check the live?
No. Can you plug your phone? Because I'm going to have to text you.
Did you check the live stream? Make sure it's okay. The live stream on okay. Make sure. Non me vedo. Arrivederci. So it doesn't look good for Bitcoin. Shoulder, head, right shoulder. We had dreams. We had visions. We had plans of bullishness. We wanted to break on out of here and make some bacon on the beach here. Can we still get a move? Is this a bear trap that's going to continue us further to the upside? How can we figure this out? What probabilities are we going for? Well, the stochastics RSI are one to start. 15 minutes says we go lower. But so far, could get a bounce. And the 1 hour actually had some legs. Started its move on up, but then was completely kiboshed by resistance. It's about to close a bearish engulfing candle. That's going to close in 36 minutes, though, so we have some time. before Mr. Jerome comes on to the stage. So we will see. And only time will tell here. Bitcoin. And we await the words of Jerome Powell. Right now, nothing burger, sideways. Let's go over what I'm looking at on the bigger picture. All right. And I'm going to give you another chart nice and clean. Look at that, man. These things just... Coins from last cycle are deed. Like they are not, they don't seem like they're coming back, man. You know, maybe, who knows, but doesn't look like it to me. So big picture status for Bitcoin at 3 days is that the daily, you know, we really would like to see this daily pop. But is that the daily is going to make a move out of this falling wedge back to the top of the channel. That's what I'm looking for. 68% of the time. And this massive wick here kind of tells a story, right? And the fact that we reset on the stochastics with we still had like 3 green candles and a massive wick. Usually when the daily resets, it's, you know, and again, let me show you. When the bears were in control, we went from dotted line to dotted line, and they were able to take Bitcoin down pretty nicely. Then they had their next move, and they couldn't take it down as bad. And then we had a pump, and then the bears had their next. So each time the bears throw shade at us, it looks like they have less and less. They give us higher lows each time. I mean, we are, you know, you'd have to. So for me, I would have to see a daily candle close here. We'd have to get a daily candle to close. And then I would assume our next would be a lower high, and then maybe there we're making some type of head and shoulder, and we're done and we're cooked. And you know, so anyone who says the bull market's over, I can't agree with that statement. It doesn't make sense to me. It just doesn't. I don't mean to be rude. I'm being honest. You know what I mean? It doesn't look like that's going to be what's going to be happening, right? Anyway, we'll take a look at USDT.P on the perpetual, and we'll be looking at Bitcoin on the smaller time frames as Jerome Powell starts to talk. So let's set up what we're going to look at and how we're going to look at it here, just to get your mind right. This is going to be on the right side of the screen. Jerome Powell is going to be in your center. All right. This will be in the right side of the screen. We'll be on a very small time frame. First thing we're going to do, though, is at least make our parameters. So the idea is, right, symmetrical triangle, which to me is broken out to the downside. You know, support and resistance still apply. And says it's going to break down to 99.6. If we get a spur of hope or something big happens, we could pump all the way to 105.8, 106,000, right? Some resistance. So this is what we're seeing. Then we're going to zoom in here onto the 1 minute chart. And just remember, like, we have broken that trend line and we're hanging out. And to me, that's pretty bearish. Where's the 21? It's on price action. But we've made some type of bullish divvy here. See? What I see, though, is more of a possibly descending triangle. And the whole thing looks like it's going to continue to dump here to the downside. Bookmap also suggests a dump. It says, hey, as risky as this is with FOMC already in, and he's just going to pour on the hawkishness, or at least not give us the bullishness that we want. One of the other, right? And so your idea would be, well, I could enter a short with a stop on the other side of that too, and possibly be alien, but it's a 2-to-1. Like, I don't get the risk reward ratio there. It's a little too tough. It's not my trade. But if I had to guess, to me, if I was going to give a trade that, you know, that made me look right, I'd say this is going to start to dump. And an entry right now in a short with a stop above the 200 MA using this high volume node as resistance would be a pretty good look. Anyway, so this will be on the right side of the screen. We're going to jump back into FOMC here. And with just minimal time, let's see if we can pull this off. All right, we're almost there. We're almost there. And it is it's 2:29 on the 29th. And here we are. At the same time, I will have Bookmap on the right side of the screen too for you. So you can at least get that price of Bitcoin in your heart and soul while we're watching Jerome Powell. All right. Little something like this. And then I will eventually, as of now, once he comes on screen, my team will shrink me down and move me to the downside. So here we go. And we're just waiting here for Jerome Powell. I'm early. He's usually on time. And there it is. Let's bring down that music, team. And let's shrink me down if you can. And everybody, let's have a great FOMC. All right. God bless.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years,
Bitcoin
but
pumping.
remains somewhat elevated relative to our 2% longer run
Look at
goal.
this. Short would have been
Estimates
stopped out.
based
I didn't
on
get
the
into a
Consumer Price
short.
Index and other
Want to
data
make that clear,
indicate
but
that
look,
total PCE
look
prices
bearish
rose
to me,
2.6%.
We did have a
over the
divergence.
12 months ending in December, and that, excluding the volatile food
Look at the
and energy
resistance there.
categories, core PCE prices rose
Pumping now. We crossed the 200
2.8%.
MA. I may get into a long.
Longer-term inflation expectations
Hold on, let's
appear
see
to
here.
remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices
Just
for the
crossed the
American
200 MA.
people.
That could be a nice pump.
We see the risks to achieving our employment and inflation goals as being roughly in balance,
Too far for the
and we
20.
are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews.
Resistance by the 100, 200
Our
May.
review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer-run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-run inflation
Technically, the
expectations
shorts still be in the money
well-anchored.
now because
Our success in
never
delivering
really
on
went
these
too
goals
high.
matters to all Americans. We understand that our actions affect communities, families, and businesses across
yada,
the
yada,
country.
yada, yada, yada. We say
Everything we
the
do
same thing.
is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
He just spewed the same thing he said all 3 times.
Mr. Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a 3-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if any, does a president making these kind of remarks have on policy? Thank you.
I don't get into
3
politics.
questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve
shoulder,
our
head,
goals,
shoulder?
and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated this demand to you?
I've had no contact.
Thank you.
Thanks.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was
That's
meaningfully
just funny to me. I don't know, maybe not to you.
Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved moved largely to maximum employment. So we literally look at the movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive, and for that reason, we're going to be focusing on seeing real progress on inflation, or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy warrant meaningfully restrictive interest rates, and would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned,
Pump
to
for Bitcoin.
balance the achievement of our two
above the 200 MA.
We want policy to be restrictive enough,
and we take a long.
Continue to foster further progress.
We'll take a long right now. We'll see what happens.
We don't need to see further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really
very
been
small position.
Broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance, and I'd say you look at the last couple of inflation readings, and you see we don't overreact to two good readings or two bad readings, but nonetheless, the last couple of readings have suggested more positive readings. So I think policy is well positioned.
Nice pump for Bitcoin. Look at this.
Colby Smith with the New York Times.
Colby.
Jerome, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look.
Look at that huge pump for Bitcoin. I mean, that thing was golden.
A little bit of language clean.
Hit the target, cleaned out.
A reference to since
we passed the 200 MA, and boom, we are gone.
To the labor market.
And this trade is cooking.
We just chose to
we are cooking, good looking.
Again, I mean,
let's go 44% over here. Should have put way more in there, but I'm happy.
And there was another inflation reading, I guess, just before the December meeting. So we've got
huge pump for Bitcoin.
Two readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret too good or too bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize
that's too far for the 21. Look for that to crash pretty fast.
Especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned.
Go back to 104.90.
I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do, this is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and
wait,
kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Michael McKee.
Michael McKee from Bloomberg Television.
Michael McGee.
You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that
it never does that?
There's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult beyond just a month.
But that's what you do, though. I mean, you base all these things off of what's going to be.
There's probably some elevated uncertainty because of significant policy shifts in those four areas that I mentioned: tariffs, immigration, inflation, fiscal policy, and regulatory policy. So there's probably
come back to the
some
21.
additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder, and meaning, plausible could be, but honestly, you wouldn't stand behind it because you just don't know, and so you're just on hold waiting to see what comes down. It's a very large economy, and policy is affected at the margin, but we're going to wait and see.
Well, if I can follow up, the idea that you feel that policy is restrictive suggests that the Fed in general wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you should hold?
We're looking. It's more the other. The way it works is we are looking at the data to guide us in what we should do, and that's what
it's a
we
bunch
do.
of baloney.
Right now, we feel
it's
like
a bunch of
we're in a very
malarkey,
good
Michael
place.
McKee.
Policy's well positioned. The economy's in quite a good place, actually.
Good question, Michael.
As well, and what we do expect is to see further progress on inflation, and. As I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster, we could then be in a position of making further adjustments. But right now, we don't see that, and we see things as in a really good place for policy and for the economy, and so we feel like we don't need to be in a hurry to make any adjustments.
Howard.
Howard Schneider with Reuters. Thank you very much. In 2021 at a central bank conference, you said, quote, throughout my career in both public and private sectors, I've seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent by investing in and retaining a world-class workforce. First question is, do you still believe that? And if so, how do you intend to put that belief into practice while remaining consistent with the recent executive order prohibiting diversity and inclusion efforts?
So let me say yes in answer to your first question. But
a waste of time question.
To the second question, I want to say this. We are, like others, we're reviewing the orders and the associated details as they're made available. And as has been our practice over many administrations, we are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this whole set of issues.
Well, if I could just follow up quickly on that, I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law, right?
Which is governing.
Elizabeth.
Which doesn't answer his question.
Elizabeth Schulze with
He said, because they're the ones making the law. That's not the same.
Steve's question. What reassurance can you give the American public that the Fed will continue to operate independent of politics under this administration?
As I've said countless times over the years, this is who we are. This is what we do. We study the data. We analyze how it will affect the outlook and the balance of risks, and we use our tools to try to.
The guy's spot on, guys. I'm telling you.
Our best thinking, try to achieve our goals. That's what we do. That's always what we do. Don't look for us to do anything else. And that's lots of research shows that's the best way for a central bank to operate. That'll give us the best possible chance to achieve these goals for the benefit of the American people. That's always what we're going to do. And
a pump to 105 looking likely here. Out this flag to the upside for Bitcoin.
Wait and see mode based on the policies that come out of this administration. Has the Fed started to model what policies
we are
like
pumping
mass
in this long now.
changes in immigration policy
I
specifically
scooped along when he said it was all good. I said, okay,
okay,
I'm in there.
So one of the things our staff does is they look at a range of possible outcomes, and they tend to go from really good to really bad, and it's one of the best things that they do. And in each teal book, you can look at the 5-year-old teal books and see there are alternative simulations. So that's what they do. There'll be a baseline, and then they'll show 6 or 7 alternative scenarios, including really good ones and not so good ones. And what those do is they spark, the policymakers to sort of think and understand about the uncertainties that surround this. So yes, the staff does that, and we're all well aware that the range of possibilities is always broad, and not just now, but always. And it's hard to be open to just how broad the possibilities are for an economy. No one saw the pandemic coming, and it changed everything.
I did.
So things happen, but yes, we do that. But it's different. It's one thing to do that, to make assessments about what might happen and begin to think about what you might do in that case, but you don't act until you see much more than we see now.
Katerina.
Katerina Saraiva, Bloomberg News. Last month you talked about a future rate cut as being pretty, significantly predicated on more progress in inflation. With the characterization of the labor market in the statement today, would you say that that's even more so the case now?
I'd say it's the same. We want to see, further progress on inflation. And the story's there. We're just going to have to see the data. At the end of the day, it comes down to 12-month inflation, because that takes out the seasonality issues that may exist. And we're just going to need to see that. We think we see the pathway for that to happen. One example, a key example, is that you now do see owner's equivalent rent and housing services, the way it's calculated for PCE. You see that coming down pretty steadily now, and that's the place where most of the remaining gap is. In addition, a big part of the overrun, as you will know, was from non-market services, which don't tend to send much signal. So you can look through all that and think, okay, that then we seem to be set up for further progress. But being seemed to set up for it is one thing, having it is another. So we're going to want to see further progress on inflation. But remember, we're not, we're under 2%, but our goal is 2%, and we do mean to get back sustainably to 2%.
Never happening.
And in terms of the labor market, how
never going to happen.
Is that broadly? You said a broad set of indicators show that it's in pretty solid place. Was there broad agreement on that? There's been a few underlying indicators that are showing perhaps some weakness, a low hiring rate, workers reporting that it's increasingly difficult to find a job. Is that of concern to the committee?
So you're right. We look at, of course, a very broad range. So it starts with unemployment, with the unemployment rate, employment participation, wages, job quits, are people quitting, that kind of thing, the ratio of vacancies to unemployed. We look at all those things, and you put your finger, though, on it's a low hiring environment. So if you have a job, it's all good, but if you have to find a job, the job finding rate, the hiring rates have come down, and that's more typical of a. Let's say that the unemployment, that the labor market is at a sustainable level. It's not overheated anymore. We don't think we need it to cool off anymore. We do watch it extremely carefully. It's one of our 2 goal variables. But I'd say we watch those things quite carefully. But nonetheless, overall, look at the aggregate data in the labor market. The labor market does seem to be pretty stable and broadly in balance when you've got an unemployment rate that has been pretty stable now for a full half a year.
Edward.
Thank you. Thank you, Mr. Chairman. Edward Lawrence with Fox Business. On employment, you said there's a broad range of possibilities, but last September you said, quote, "We understand that there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise." Now that the flow of the border has slowed and we're seeing deportations, how do you expect the unemployment rate to react?
So what's happening is that the flows across the border have decreased very significantly, and there's every reason to expect that to continue. But job creation has come down a bit too. So if those two things come down together, that sort of can be a reason for the unemployment rate to stabilize. In other words, the break-even rate, as population growth slows, the break-even rate that you need in new jobs to make make jobs for workers declines as well. So that seems to be something about what's happening. You do see a very flat unemployment rate at a time when you've seen significant declines.
I want to ask you about Fed employment.
This flag's looking nice for a pump, everybody.
Used here, but Elon Musk.
I'm in the long. I see we're going to get a pump to 105.6 here.
We've seen the executive branch push to reduce the federal workforce. I just want to get your reaction.
We run a very careful budget process. We're fully aware that we owe that to the public, and we believe we do that. I've got no further comment than that. Thanks.
Chris.
Breaking news, USDA Inspector General Phyllis Fong physically removed from her office as she refused to leave after Trump fired her.
By reducing gas and energy costs.
God, Reuters.
Do you see such costs as a particular driver of inflation, and would lowering them have a dramatic effect?
Chris, I'm not going to react or discuss anything that any elected politician might say, so I'll give you a mulligan.
Okay, thank you. Well, nearly 2 weeks ago, the Fed said it was withdrawing from the network for greening the financial system, even as we have significant wildfires in Los Angeles doing billions of dollars in damage. And of course, the NGFS, as you know, is a group to talk about how the financial system could address climate change. Many commentators did see the timing as political. Why did you leave that organization? Can you explain that decision?
Sure, I'd be glad to. So we considered this, really at length, and we did decide to withdraw from the NGFS. And really the reason is that the work that the NGFS does has broadened very significantly. You think about nature-related risks. And
looks like they're going to go get this stop hunt at 105. But
in addition,
what do I know?
The work
I just go live every day, probably wrong.
Is in significant part intended to, and this is a quote, mobilize mainstream finance to support the transition toward a sustainable economy. So we joined to get the benefit of understanding what other central banks were doing and seeing research and things like that. I think this is just way beyond any plausible mandate that you could attribute to the Fed. And so we have a quite narrow role, as I've said many times, and I think that the activities of the NGFS are not a good fit for the Fed.
He's not being too hawkish.
Given our current mandate and authority. So, and I just think it was time to acknowledge that, this process dates back a couple of years. I made the decision to bring this to the board some months ago. The process just took time to get here.
Bears div here, see.
This is when we got it and voted on it. So, and I'm aware of how it can look, but it was really not driven by politics. It was driven by kind of the disconnect between the work of the NGFS and our mandate.
The thing is, when the Stokes reset
mandates
and price goes sideways, you're usually going to get a pump.
Criticism of them, but it just isn't. It's not right for the Fed.
And he's super dovish right now.
Thanks. Andrew Ackerman with the Washington Post.
He's not dovish, but he's not
I wonder if you could talk
hawkish,
more about
what
further progress would look like for consumers.
Well, 2% inflation down to 2% sustainably is what we're trying to achieve. We're somewhat above that, as you know, and we want to see serial readings that suggest
not going to happen.
Making further progress on inflation. That's what we want to see.
I'll run for the president on that in 2032. Never get there.
Of course, in the things that they buy.
Never get to 2%.
Grocery store or at the store.
The other thing I wanted to ask was just how far away you think you are from neutral.
Yeah, you can't know with any precision, of course.
How do you make the call on to raise the rate then?
By its works. So I think, at 4.3%, we're above pretty much everyone on the committee's estimates of the longer run neutral. I think our eyes are telling us that our policy is having the effects on the economy. That's really the question we ask. You can consult models, empirical models, theoretical models. You really have to just look out the window and see how your policy rate is affecting the economy. And I think we see that it's having meaningful effects in bringing inflation under control. It has helped bring the labor market into balance as well. So that's what we think. I would say we're meaningfully above it. I have no illusion that anyone knows precisely how much that is. But not knowing that and having cut 100 basis points means that it's appropriate that we not be in a hurry to make further adjustments.
Victoria.
Victoria Guido with Politico.
Looks nice. The flag looks good to go.
When it comes
21,
to
low
executive
stochastics
orders
curving up.
and OMB
Boom, boom, boom,
memos,
boom.
do those always apply to the Fed?
I stay long, baby. I stay long and you shorts. Who's short? Who wants to counter trade me? Let me know.
What is the legality there?
Who wants to counter trade me? Let's find out.
As I mentioned,
Put a 3 if you're put a 4 if you're counter trading me.
our policies to those that are mentioned in
Put a 4 if you have
executive
the
orders,
guts
and
to put a 4 and counter
as I
trade
mentioned,
me.
I'm not going to
Put a 4 down if you're counter trading me. Put a
any
4.
deeper than that or
Write
get
4
into
down
any
in the
deeper
comment
into the set of
section
issues
if
today.
you have the guts to counter trade me.
Claire.
All right, let's see what happens to you.
Claire Jones from the Financial Times. 2 questions, if I may, on tariffs. Well, first of all, we've seen global trade wars before, notably in 2019, last time around. But
2019.
then we were in a very different place on both inflation
Different
and growth.
place.
If we see tariffs of the same sort of magnitude that we got then, which I know is big if,
Big
what do you
iffy,
think might be different this time around? And secondly, Tiff Macklem said there was no doubt that the threat of tariffs was a big driver of the cut by the Bank of Canada today. What sort of information would the Fed need to see on tariffs before it was willing to take such a preemptive
Answer
move?
those questions.
Sorry,
What sort of information would you need to see on tariffs? Would you need to see a strategy, actual implementation, actual movement of inflation expectations before you're actually willing to change the path of
That's a
monetary
bullpen and on the 1 minute time frame.
basis of it?
Yeah, so we just
has some kind of Adam and Eve vibes
things are a
too
little
there.
different now. We've just come through a high inflation period, and you can argue that
Where the 21's
both
kicking,
ways.
I would say the
that
shorts are about to
companies
get
have figured
wrecked.
out that they do like to raise
Look, there's a
prices,
bunch of
but we also
liquidity
hear
right
a
there
lot from
at
companies these
105.
days that consumers have really had it with price increases.
So we're going to pick out all the number
I don't know how
4s
that
here,
shakes
and when
out.
we rip,
Nonetheless, you're coming through a situation.
we're going to call you
where we're not
out.
quite
and
back to 2%. and
we love you,
that's
but
just different. In addition,
and again, maybe I'm wrong. Maybe I get wrecked. We'll find out, won't we?
Has changed
Pretty soon. I'm just the guy that does this every day. What do I know? I'll probably get wrecked, right? Yeah.
It's not as concentrated in China as it was. There was a lot more manufacturing. It moved to Mexico and other places. So there are differences.
21's
And
curving.
I
You
just
guys
think
might win now. I don't like how that's
The
curving.
range of possibilities is
Not a good
very,
sign. That
very
has to
wide.
flip up.
We just don't know, and I don't want to start speculating as
no.
tempting as it is, because we really don't know. And we didn't know, by the way, in 2000 and I guess
I did move my stop into profit.
18. Yeah,
So I can't lose my
know.
trade.
And
There's my entry. There's my stop.
Again, the range of possibilities very, very wide. We don't know what's going to be tariffed. We don't know for how long.
The shorts
or
might
how
win
much,
here.
What countries. We don't know about retaliation. We don't know how it's going to transmit through the economy to consumers. That really does remain to be seen. You know, there are lots of places where that price increase from the tariff can show up between the manufacturer and the consumer.
We hit
Just
support
so
here
many
for a
variables,
bounce.
So we're just going to have to wait and see. And the best we can do is what we've done, which is study up on this and look at historical experience, read the literature, and think about the factors that might matter.
Did he just say read the literature? Come on,
You
man.
have to see how it.
What literature is he talking about? The diary of, you know what I mean? Like, come on, man. The little house in the prairie.
Thank you, Courtney.
Like, what the heck is he talking about?
Axios.
Charles Dickens?
2 unrelated questions. The first is whether or not
Let's
there
get real.
was any discussion about
literature?
QT and the timeline for ending QT at this meeting. And then the second
Read the
question is
literature.
just, I wonder if the AI-prompted sell-off in the stock market this week signaled anything to you about the state of financial conditions?
So, let's talk about runoff. So the most recent data do suggest that reserves are still abundant. Reserves remain roughly as high as they were when runoff began, and the federal funds rate has been very steady within the target range. We track a bunch of metrics, and they do tend to point to reserves being abundant.
That's a Adam and Eve.
Reduce the size of our balance sheet to a level
Definitely
that's consistent
resistance
with
at
implementing
103.8
monetary policy
right now.
efficiently and effectively in our ample reserves regime. We're closely monitoring a range of indicators to assess conditions, and that should provide signals whether reserves are approaching a level that could be judged as, quote, somewhat above ample. I don't have anything to say to you about particular dates. It's just that's the process, and what we see is that rates do appear to be abundant. As always, we stand ready to take appropriate action to support that smooth transition of monetary policy, including to adjust the details of our approach for reducing the size of the balance sheet in light of economic and financial developments. On AI, it's a big event in the stock market and in particular parts of the stock market. I mean, what really matters for us is macro developments, and that means substantial changes in financial conditions that are persistent for a period of time. So I wouldn't put that label on these events, although, of course, we're all watching it with interest.
Simon Urbanovich with The Economist. Thank you. You mentioned in your remarks that activity in the housing sector seems to have stabilized. At the same time, since your first rate cut in September, long-term mortgage rates have gone up by a full percentage point back above 7%. I'm wondering, kind of looking forward, are you confident that activity will remain stable given how elevated mortgage rates are? How does it fit into your broader thinking about the economy?
So, as you know, as we've reduced our policy rate 100 basis points, longer rates have gone up, not because of expectations, not principally because of expectations about our policy or about inflation. It's more a term premium story. So, and it's long rates that matter for housing. So, I don't think I think these higher rates are going to they're probably hold back housing activity to some extent if they're persistent. We'll have to see how long they persist. So, we control an overnight rate. Generally, it propagates through the whole family of asset prices, including interest rates. But in this particular case, it's all happened at a time when, for reasons unrelated to our policy, longer rates have moved up.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you want to see further progress on inflation. Given that households appear to be unhappy with the elevated level of prices, do you believe the committee should wait until inflation has fallen back to target to cut rates again?
No, I wouldn't say that. We've never said we need to be all the way at target to reduce rates. At any time, what we're doing is we're looking at the economy and asking whether our policy stance is the right one to achieve maximum employment and price stability. So I think if we would want to see further progress, but we think our as I mentioned, we think that our policy stance is restrictive, meaningfully restrictive, not highly restrictive, but meaningfully restrictive. And so I would think we need to see further progress. I wouldn't say all the way back down to 2% on a sustainable basis, although we'd love to see that, of course, and we will.
And separate question for you on tariffs.
I say no.
Curious whether the threat of tariffs and not knowing whether they could stick or not creates uncertainty for business here in the United States and could cause them to pull back, ultimately weighing on growth. Does the threat of tariffs cause you to ponder your growth forecast?
I want to avoid commenting even indirectly on the conduct of tariffs. It's not our job, and it's not our job to comment on the moves that people make. So I wouldn't want to criticize anything that's happening or really comment on it one way or another, praise it for that matter. It's just not our job. I do think that, we found in 2018 there was a lot of work done on trade policy uncertainty. Trade policy uncertainty, if it's large and persistent, can start to matter.
Please subscribe to the channel if you like what you're getting, information, having a blast.
That's not something I'm observing.
Let's get to 89,000 subscribers
it's very
today.
Early days for this, but
I'll greatly appreciate it.
I think that did matter in 2018-19, and it's one of many things we'll be watching.
Matt Egan.
Thank you, Chair Powell. Matt Egan from CNN. Following up on Courtney's question from earlier about the stock market, how concerned are you, if at all, about potential asset bubble brewing in financial markets? How do relatively high market valuations factor into considerations about potentially lowering interest rates further? Is that something that's in the back of your mind?
So we look at, from a financial stability perspective, at asset prices generally, along with things like like leverage in the household sector, leverage in the banking system, funding risk for banks and things like that. But it's just one of the four things asset prices are. And yeah, I'd say they're elevated by many metrics right now. A good part of that, of course, is this thing around tech and AI. But we look at that. But, we look at how resilient the households and businesses and the financial sector are to those things. So we look at that mainly from a financial stability perspective, and we think that there's a lot of resilience out there. Banks have high capital, and households are actually overall, not all households, but in the aggregate, households are in pretty good shape financially these days. So that's how we think about that. We look at overall financial conditions, and you can't just take equity prices. You've got to look at rates too, and that represents a tightening in conditions with higher rates. So overall, financial conditions are probably still somewhat accommodative, but it's a mixed bag.
Richard.
Hi, Chair Powell. I'm Richard Escobedo with CBS News. One question for you. This month's statement notes that unemployment has stabilized at a low rate and that the labor market is solid. You walked through some of what's driving this, but I wonder what risks you see that might challenge your assessment.
Well, the things we discussed earlier, one is that there's a low hiring rate. And so that if there were to be a spike in layoffs, if companies were to start to reduce headcount, you would see unemployment go up pretty quickly because the hiring rate is quite low. So that's one thing we look at. I think it's worth pointing out that for lower income households, they're under significant pressure. And in the aggregate, the numbers are good, but we know that people at the lower end of the income spectrum are struggling with costs. And really, it's high inflation for the basics of life. It's not so much the inflation now, it's the price level, because inflation has raised prices. Inflation is now much closer to target, but people are really feeling that. But, overall, this is a good labor market. You're at 4.1% unemployment. That's just a really good level, and you've been solidly there now for 6-7 months. And job creation is pretty close to a level that will hold the unemployment rate there, given that there'll be much slower population growth.
One more question. Some of the uncertainty around immigration policy, in your assessment, is that making it harder for businesses and the Fed to plan going forward?
We hear anecdotal reports, but I don't see, there's nothing in the data yet on that, but you hear that kind of thing about construction, for example, and businesses that are dependent on immigrant labor are saying that it's suddenly gotten harder to get people. But I know you don't see that in the aggregate data yet, but yes, you hear it anecdotally.
Nick.
Thank you, Chair Powell. Nicholas Jasinski from Barron's. The uncertainty is certainly a theme today, and I'm wondering, are there any periods from your career or as it relates to markets, the economy, what's going on here in Washington and beyond, or from lessons from history that may provide some guidance for a central banker operating in uncertain times like today?
I guess I'd say this.
What a question.
Uncertainty is...
Try to put them in the spot or some type of information.
It is human nature, apparently, to underestimate how fat the tails are in a way. The possibility, we think of things in a normal distribution, and in the economy, it's not a normal distribution. The tails are very fat, meaning things can happen way out of your expectations. It's never not that way. I wouldn't, if you think about it, think about the first few months of the pandemic. That was uncertainty. Are we going to be able to reopen the economy? If so, when? How much of it? How long will it take? That was uncertainty. What we have now is a good labor market. We have the economy growing at 2 to 2.5%. Inflation's come down to now the headline inflation number was 2.6, and that's what the public experiences. We look at core because it's a better indicator of future inflation. So yes, the price level went up a lot for inflation, and people are feeling that, and they're not wrong. But So the kind of uncertainty we have is just a usual level of uncertainty about the economy, but then policies which are, not for us to criticize or praise, really. Those are policies which people have been elected to implement. They're implementing them with a view to making a better economy. And so I wouldn't call this out as one of those times. I wouldn't compare it to the global financial crisis or anything like that, given that we have actually a very good economy right now.
Evan Reiser with Market News International. Chair Powell, is a March cut still on the table? And then additionally, are you looking to see better than expected data on inflation to cut? Or are you looking for inflation data that roughly aligns with current forecasts?
So as I mentioned, the economy's strong, the labor market's solid, downside risks to the labor market appear to have abated, and we think disinflation continues on a slow and sometimes bumpy path. That tells me, and the other members of the committee, the broad sense of the committee actually is that we don't need to be in a hurry to adjust our policy stance. Your second question was?
Whether or not you need to see better than expected inflation data or just inflation data that roughly aligns with your current forecasts.
It's one of those things, we'll know it when we see it, but more the expectation is that we will make continued progress. And, that's what we want. We'll know it when we see it. It's
still sideways in the flag of the one-minute time frame.
Idiosyncratic. You're going to want to see, continued progress with housing services.
Not much of nothing burger today. Hasn't said he's not being hawkish. He's not. If anything, you want to look at the shoulder, head, right shoulder. Possible move out of here.
And
still kind of getting sideways.
Better than our expectations.
Good consolidation so far, above 103K.
Hi, Chair Powell. Scott Horsley from NPR. In your 5-year review, you said the 2% inflation target won't be on the table. Can you talk a little bit about why? Is that because you think that's the right target, or is it because you don't want to move the goalpost mid-game, or what's behind that?
I think that goal has served us well over a long period of time. It's also the sort of global standard. I think that if a central bank wanted to look at changing that, you wouldn't do it at a time when you're not meeting it anyway. I would not look at changing it anyway, but I certainly wouldn't look at it at a time when you're not meeting it. There's just no interest at all in changing it. If I'm being at all unclear, we're not going to change the inflation goal anytime soon.
And 5 years ago, if I can paraphrase what y'all decided, it was you're going to not raise interest rates preemptively to head off inflation until you see sort of the whites of the eyes of inflation, because the solid labor market was so beneficial. Have the last few years changed your thinking about that?
So what we really said was that we wouldn't look at a strong labor market and raise rates unless we saw some evidence of inflation. So the thought was that we'd seen really low levels of of unemployment with no signs.
This is really just a nothing burger today, everybody.
Preemptively want to put
just a bunch of nonsense. The questions don't make sense and the answers don't either. We're not getting anywhere here. You know what I mean?
This was not a sustainable level.
I'm just
a way of acknowledging how much humility we have about the
watching the patterns funner than anything else here. To be honest,
rate of unemployment.
Usually he's kind of funny in what he's doing. This is just a bunch of nonsense.
We'll discuss that again. That'll be one of the.
He's like talking coffee and donuts today.
That insight is wrong.
They're about to end this in a few minutes.
What we said was that at times when inflation persistently undershot 2%.
Yeah, nothing burger's better than nothing. It's just nothing burger. You know what I mean?
Allow inflation to run moderately above 2% for some time. That's what we said.
This could go either way, though. See how it's kind of
turned out not to be relevant to what actually happened. There was nothing moderate about the overshoot. It was an exogenous event. It was the pandemic, and it happened. And our framework permitted us to act quite vigorously, and we did once we decided that that's what we should do. The framework had really nothing to do with the decision we looked at the inflation as transitory.
That looks like it's going to dump
now.
now.
To the point where the data turned against that, and when the data turned against that in late 21,
it's a lot of fickle price action. You have a lot of people on either side doing a lot of crazy things. It's going to affect the price. And I give it a couple hours to mill out before you get back in.
Was more irrelevant than anything else. That part of it was irrelevant. The rest of the framework worked just fine as we used it, as it supported what we did to bring inflation down.
Let's go to Mark for the last question.
Hello, Chairman Powell. Mark Hamrick with Bankrate. As you know, in the annual report from the Financial Stability Oversight Council, among the risks outlined is cryptocurrency. Could you talk about those risks now? And regarding individuals and households, perhaps distinct from the concern about the financial system, do you worry that speculation in this unregulated asset class could hurt their financial well-being, or do you think it has a place in a household's portfolio?
So our role with Bitcoin really is to.
He said Bitcoin. Oh my God.
Really is to look at.
He said the word Bitcoin.
And
that guy said crypto. He said Bitcoin.
Banks are.
I've never seen Jerome Powell say Bitcoin in my life.
Serve crypto customers as long as they understand and can manage the risks, and it's safe and sound.
He says bullish, man. He's bullish. This is it. We're gonna pump. That's it. It's over.
Do that. The threshold has been a little higher for banks engaging in crypto activities.
I'm being jokingly, but this is all the markets need. They act so frivolously on this stuff.
If you're making a choice to conduct that activity,
and this is just going to rock it.
A bank, which is inside the federal safety net,
that thing could
with deposit insurance, then you want to be pretty sure that it's a safe and sound activity. So
all the way to 106, baby.
We're not
shoulder, head, right shoulder, and we're gone. He mentioned crypto the second he mentioned it.
To take actions that
he said the word Bitcoin. What a question.
To terminate customers who are perfectly legal just because of excess risk aversion may be related to regulation and supervision. So.
And with respect to
look at that. Inverted head and shoulder, Bitcoin long.
That's
let's go, baby. Let's go.
It's not really our bailiwick.
Let's go. Let's go.
About the financial engagements that they have, and that's why we have the
a nice bullish retest too, off of the top of the trend line here to the upside on the 5-minute time frame.
Individual stock prospectus. You want households to have the chance to.
And the inverted head and shoulder about to get busy here to the upside.
I think it would be helpful
for Bitcoin
if there were a greater regulatory apparatus around crypto, and I think that's something.
I can't believe he just said Bitcoin and cryptocurrency. I've never heard him say this. This has never happened. I've never heard him say the word Bitcoin in my life.
On various things, and
he was bullish about it.
Constructive thing for Congress to do.
This is insanity.
Thank you.
He's gone, and I'm gone. God bless each and every one of you for being here. He ended with cryptocurrency, and we're going to pump to the upside. I see $106,000 BTC all the way here for Bitcoin. We get this move to the upside here for BTC. Continue to pump to the end zone. I like what we're seeing here for Bitcoin. All right. Only time will tell, but so far so good. I got to jump out of here and do the do. But God bless you. Watch this flag as it continues to go sideways. Make sure the 1 minute stays above the 200 MA. We could continue to pump here. That was interesting in and of itself. And again, I still am not sure. I'm going to let the dust settle here, and I'll be back to the trading group in about a couple hours to kind of really see how I'm looking at the market, reassess, and we'll go from there. God bless each and every one of you. Thank you so much for jumping on in and being a part of this double stream. Every single FOMC, we nail it. We're also going to be back for that monthly candle close. The streamer that hits it every single time. We never miss for you guys. We love you. We appreciate you. And thank you so much. We'll see you tomorrow.